Hi, I'm Rahul Chadha. I'm the Chief Investment Officer for Mirae Asset Global Investments Hong Kong and the lead PM for India Sector Leader Equity Fund. I'm here in front of you today to talk about the investment case for India and how our fund is positioned to make the best out of this investment opportunity. Driven by superior demographics, a rising middle class, low household debt, and a progressive government, India is one of the most exciting growth stories in Asia. The devastating COVID-19 wave in 2020 and early 21 did take sheen off the growth story. However, the economy is slowly bouncing back on back of prudent pandemic management by the government by virtue of localized lockdowns and a massive jump in daily vaccinations. COVID-19 cases, after peaking around 400,000 in May 2021, are now below 40,000, primarily confined to the southern state of Kerala. As of mid-September 2021, 60% of the population above the age of 18 years have got at least one dose, with a total of nearly 800 million doses being administered. Daily vaccination improved significantly from April-May levels to 5.5 million doses in August, while in recent weeks in September, we've seen vaccinations as high as 7 to 10 million a day. Should the vaccination pace continue at this trajectory, risks of a severe third wave during the festival season in October-November should be significantly reduced. We believe this was due to several reasons. India is well positioned for economic recovery, driven by negative real interest rates, robust forex reserves, and strong pent-up consumer demand. Moreover, limited capital investments in recent years should lay the foundation of a new investment-led economic cycle. The sheer construct of the Indian market, when the domestic cyclical stocks in consumer financial space were under pressure because of COVID, the global cyclical stock like software services, commodities did well because of a buoyant global outlook. As the second COVID-19 wave eased, property registrations in Mumbai, Maharashtra and Delhi have crossed June 2019 levels, and the reality website traffic is also above the pre-COVID levels, indicating underlying housing cycle strength. This has benefited property developers as well as supporting industries. 2015 to 2019 saw economic disruption from demonetization, GST implementation, and a cleanup of the prior cycle corporate debt. The benefits of digitization, infrastructure, and electrification are yet to be felt. We believe that there are limited historical excesses, and a low level of household leverage at 18% would ensure quick recovery in the coming years. The Make in India program was gaining momentum prior to COVID. The expectation post-COVID is that with realignment in global manufacturing, India should potentially benefit from the shift in manufacturing and supply chains by offering comparable or better terms than other competing countries in South or Southeast Asia. Initially launched for mobile phone manufacturing, Government of India has extended the production-linked incentive schemes to nearly 10 sectors and is adding more sectors with every passing month. The incentives amount to 5 to 10% of sales over the next 5 years to promote domestic manufacturing. These sectors would include automobiles, automobile components, advanced cell chemistry for battery cells, steel products, air conditioners, LEDs, pharmaceutical products, telecom and networking products. New sectors which have been added include solar PV cells, textiles, food processing, etc. Domestic value addition is expected to grow from current 10 to 15% to 35 to 40% in case of mobile phones and 45 to 50% for electronic components in our view. On the consumption front, in my opinion, PLI could create about 200,000 direct jobs and 600,000 indirect jobs over coming 5 years. India's internet sector is at an inflection point to witness hypergrowth in coming years, with technology companies steadily disrupting the traditional services. A supportive government, tech-savvy young population, online digitization of SMEs, and a well-funded private equity venture capital ecosystem suggests that stars are aligned to create investor value in the coming decade. The majority of tech companies are focused on the top 100 million affluent users. These are now expanding to cater to the next 100 to 200 million as credit availability is helping drive usage for the sector. Total e-commerce industry will grow to about $100 billion plus by 2025 from a 33 billion in 2022 with a CAGR of 27%. We expect the e-commerce to be the third largest online vertical, following fintech 300 billion and logistics about $160 billion. There's a robust pipeline of these technology IPOs in India. COVID-led disruption in 2020 has provided a significant tailwind for some of these internet companies. Our team's learning while investing in similar business models in China and Korea is a strong advantage while evaluating such opportunities in India. We are positioned for an impending cyclical recovery in our Indian portfolios. With rising income and premiumization in coming years, we believe the Indian consumption basket will shift away from basic sustenance items such as food to more discretionary consumer items such as consumer durable, jewelry and autos. This is set to benefit the leaders we own in these fast-growing yet nascent categories. Outside consumption, capital investment, infrastructure development and housing is a multi-decade opportunity. We continue to be overweight financials, real estate, industrials, sectors which are benefiting from improving economic outlook and market consolidation. Post a strong performance in 2021, markets may take a breather on back of lingering concerns of the Delta variant and the US Federal Reserve's tapering announcements. However, the longer-term investment case for India remains on track and will take any pullback to increase our exposure to the market. Thanks for watching this.